Welcome to Trading with Rich. This is Rich Dickey. This section is about the stock market. I'm going to try to condense it down to about 10 minutes, basic understanding of the stock market, so that when you trade covered calls and puts, you kind of have a basic understanding of what the market is all about. So understanding stock market pricing. Very, very difficult to pick stocks and assume that you're just going to jump right up day one. It's really pretty hard to do. Why is it so hard to time the market in the short term? Well, you have to understand that the market makers, they control the pricing. The banks, the hedge funds, the mutual fund managers, that's part of the problem with being a day trader. When you jump in there in the morning, the computers are making thousands of entries and trading stocks right there at the first minute that the market opens up, and how are you supposed to know which way it's going to go, up or down? When they control hundreds of thousands of stocks, and they control, and I'm talking about all the stock, individual stocks for a company, when they decide to go ahead and sell, it's gonna start going down because the market is a supply and demand market. So just to give you an idea, 10 years ago, there were 10 million trades a day, the Monday through Friday stock market. Today, there are over 1 billion trades a day. So if you think you're going to jump in there and time it just right, and it just doesn't work out well. 90% of the people that are day traders end up losing a lot of money. 10% get it right, but I'm not willing to take that gamble. So there's an old axiom that the market makers build it up just to take their profit. Then they, after it's gone down, then they come right back in and they buy it cheap. The problem is we are the retail stock market pickers, okay? The retail trader gets nervous when he sees it go down and he's afraid he's going to lose too much money and boom, sells it on the way down. Then the market makers, next day, they buy, they go ahead and drive the price back up. So what's the answer to all this? You may get frustrated. Don't. It's not that hard. You've got to pick stocks from good companies. Always pick a stock that you would like to hold for 2 to 5 years. Now you can go out on YouTube and people talk like that all the time. They buy and they hold. Trying to pick first thing in the morning and have it sold by 10 o'clock in the morning, 11 o'clock in the morning, do that for fun, because that is just pure gambling. So why are you standing on the sidelines? Are you nervous that you can't do this? It's really not that hard. I'll say it 100 times. It's really not that hard. That's why you're here. Let's take a closer look at some of these stock market theories. And remember, the 50-yard line seats don't impress me. I came to play. So why are there hundreds of videos on trading theory and not many on how to trade online? You can poke around and you can find, there's a few. I saw a few videos out there where companies were offering to teach you how to actually trade, and then later even actually work for them, and on pretty much on consignment you trade stocks for them if you get really good and you've got a couple of years and you've shown some good results with your own accounts, that type of thing. They're out there and pretty interesting. But the how to trade covered calls and cash secured puts, there's just very few, and most of them are membership sites. And I'll tell you, the ones that are out there are pretty good. The membership sites pretty much say the same thing. The one thing about this financial industry is they don't really argue too much on how to, or even the theory. It's just the bottom line is, how much risk are you willing to take? I don't like to take a lot of risk. That's why I go with a conservative approach of covered calls. And if the market goes down, I don't worry about it. It will come back up. Over the last 50 years, it's averaged about 10%. I'm not in the business to buy and hold. I use those stocks as assets. So why do firms charge thousands of dollars to teach you to trade? Well, because it can get complicated. And on the other end, they have to pay for their Manhattan offices they've got, and they need to, make sure they're making a profit. Why don't brokers want to manage your money weekly. Well, why won't your Edward D. Jones or your other brokers, any of them? They're all good folks. They're very smart. They know what their strategy is with their company. They do make money. But why won't they actually go in and do covered calls and trade every week and help you pick stocks and jump out of stocks when they get really high and sell back in when they go low, and in the meantime do premiums on covered calls? Well, because that's an awful lot of work. They're only interested in large deposit customers. It'd be too much time to spend that kind of time teaching somebody, and they'd never be able to have more than 10 to 15 customers. So why don't brokers teach their clients how to do it themselves? Because it wouldn't be profitable. Bottom line, it wouldn't be profitable. It's much easier just to take the money, put it in a mutual fund, let somebody else, like a hedge fund manager, do covered calls and puts. And trust me, they are doing that. And there's videos out there talking about banks doing 60% of their trades as puts. That's probably pretty smart. I've heard that, and that's why I do a lot of puts, just to see how well that works. It is a good way to buy a stock. If you want something cheap, put a put out there and try to see if it'll actually go down to the price that you think it will. Excellent theory. Like I said, there's no tricks to this trade. Everybody pretty much does it the same. It's just it takes time. And why am I doing Trading with Rich? So that I can actually talk to you guys online, and we can do this each week. I'll teach you how to trade every week. We'll take a look at the decisions that we make. We're going to look at strike dates, strike prices. We're going to do exit strategies, but we're going to do it while we trade my portfolios. So, why do clients feel like it's beyond their capabilities? Well, there is one little trick to the trade, and that is confuse the heck out of the general public. Industry intentionally has its own acronyms, its fees, and its smoke screens to make it seem so difficult. What are the risk levels between different options? Well, this course is about covered calls and cash secured puts. Your risk is in the stock that you pick. So you won't hear me talking an awful lot about the Greeks, the theta, the delta, taking a look at getting my cost basis at a certain amount. Those are all just terms that I think are trying to confuse people, and I'm going to try to keep things as simple as I can. I'm going to use the KISS theorem, which is keep it simple, stupid. So the Trading with Rich strategy, basically here it is. Picking a profitable stock is a 50-50 proposition. I love listening to Tasty Works' trade blog. They call it Tasty Trade. The guys are super smart. They really know their stuff. I've listened to thousands of videos now, spent hundreds and hundreds of hours trying to see if anybody's going to disagree with one another. They really don't. There's only a couple things that people disagree on, and that's the theory of risk. And the Tasty Trade people really delve into that pretty good. If you want to listen to some of their videos, I highly recommend it. So picking a profitable stock is a 50-50 proposition. Tom and Tony, talk about this all the time. There are no guarantees, no crystal balls here. I totally agree with them 100%. That's why I pick stocks that are, I'm prepared to own for 3 to 5 years. This is not day trading. If you want to do day trading, put some money aside. Plan on losing it because you got about a 90% chance of losing it. But if you make it, you could hit it big. It's just like hitting a slot machine. So, Charlie Munger and Warren Buffett talked in some videos about diversification, and I love the way they talk about it. These two fellows have been in the business for an awful long time. I highly admire them. When Warren Buffett speaks, I listen. One of the comments was diversification is the byproduct of the fear of losing. Diversification is basically just trying to hedge your bets and put your money out over several different companies. There are times when I'm up to 20 or 30 companies, and then I remind myself, reel it back in, Rich. Remember, it's a lot easier to keep track of 4 or 5 companies, and depending on how much you have in your portfolio, as your portfolio gets bigger, you can go ahead and add more stocks to it. But generally, when you get up to $1 million, you should still only have about 12 stocks in the account. Now, a lot of folks aren't going to agree with that. The pontiffs that just got out of college and they got their college degree, they're gonna swear that you've got to diversify, and you've got to diversify over to 5 different markets and have some money in oil and have some money in retail and have some money in auto. That's all fine, but you know what? I'd like to see their bank account. They don't share that. They don't put it out there. They're just an analyst that is trying to give you good information. Take that information, sort it out, add a little salt to it. But remember, they are not betting with their own money. You are. So as you'll notice when we trade on my account, my account of Trading with Rich is mainly to teach you folks how to trade. I'm not actually telling you which stocks. I'm not giving you any advice on which stocks you should take. But I'm going to share with you which stocks I bought. And you'll notice on a lot of my stocks, they have a negative red number on them. Trust me, it's hard to pick a stock when you first buy it. There was a while there I thought, man, I've got a brown thumb. There's no way that I can ever get anything to grow. Every single time I pick a stock thinking it's going to do well, it goes down. But that is the philosophy of the human mind. They really weren't going down every time. When I look at it after a month, I'm like, hey, you know what? I'm pretty much 50-50. I'm no genius. I don't have a crystal ball. But over time, they would catch up. The trick to the trade is I kept making premiums on covered calls even when the stock price went down. I didn't sell the stock. I stayed with it. It was buy and hold. And after a few months, the premiums I made up for the share price going down. In the end, the share price would come back up. I'd still have the premiums that I've made. And there was some point in time when I might decide to sell the stock at a profit and move into another stock for a while. A lot of that depends on volatility and what my premiums are paying. So that's what we're going to teach you on Trading with Rich. And one of the basic things that I'll say with my strategy is I don't do vertical options. I don't do vertical calendars. I don't do trying to guess which direction the stock is going to go. Not on a general basis. I don't do butterflies. I don't do iron condors. I don't gamble with my money in the portfolio. That's not to say that I don't go out there and do a vertical. That's kind of over in my little play account, and I have some fun with it. And I do really well with it because I'll pick stocks like Best Buy, who I used to work for, and Kroger, who I used to work for. These are companies I know real well. AMC. I love movie theaters. I used to own 7 movie theaters. So I've got stocks in AMC. Then Baidu and Alibaba. I believe the Chinese economy is going to come back. I think Trump's going to work out the China trade deals. I like to follow that stuff. My number one following is Tesla. Love to follow Tesla. Made a ton of money on it this year, at least in my opinion. A lot of money is $15,000. And in November, I made about $15,000 on my Teslas. But now I don't have any Tesla because I sold it when it got up into the 300s. And I just rode it up from 195. I kept doing covered calls, and as they would get called in because I'd hit a strike, and trust me, it was jumping $15, $20. I could never guess every week how much it was going to jump up or even when it went down. It's a tricky stock. But I love dealing with it. I think the company's going to do fantastic in the future. I really think Tesla stock will go to $500 by the end of next year. But it's currently at $330. And when I started buying it 6 months ago, it was $195. And I just rode it up. And now that it's in the 330s, I'm waiting for it to come back down or at least level out so that the premiums make sense with the product. We'll go through all that, but understanding the stock market is a key part of this strategy. You have to overcome the fear and the greed. You have to keep your cool. Don't let your fear of your stock dropping cause you to sell at the wrong times, and just your premiums are not going to make up for your fear. You will have the premiums. You'll get those. And you'll make quite a bit of money on the premiums. But if you keep selling the stock every time it drops 10%, you're never going to make enough to cover your lack of being able to trade products. So, covered calls and cash secure puts are the basis of my trading. Our next topic will be understanding the market. But for now, I want to sign off. Rich Dickey here, Trading with Rich. Hope that helped you understand a little bit more about the market.